Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Kate Campbell, welcome to this episode of the Australian Fine Arts Podcast. How are you?
I am doing really well, Owen. It is our first episode for the Finance Podcast in the new office, which is cool. I got to see the office for the first time today, so it's nice to have our own space.
Yes, it is. It's a bit echoey here, so we've got a little bit of work to do on this studio, but we'll get there. And it's good to record in person, as you said.
Good things take time.
They do, Kate. They do. Just like a lease on an office. Took 7 years to get a full lease. So here we go. I put my big boy pants on and we're doing this thing for real. But it is good to chat because we're doing a monthly update. We're going to talk about the S&P 500, how you can invest in that, whether you're in Australia or anywhere, really. We'll show you one of the easiest ways to invest in an ETF. And there's one here in Australia, which we own, called IVV. Well, that's a ticker symbol at least. And then we're going to talk a bit of a monthly update, Kate.
Yes. And once again, I had no idea when the RBA was releasing their interest rate data. So I booked this episode on the morning before the announcements. So everything we say is a pre-RBA meeting, but...
Yes, we're likely to have no change. Now, that's the likely scenario, is that there is no change to the official interest rates. So for those that don't know, the RBA, Reserve Bank of Australia, is the one that sets the interest rate. And you might hear about this in the news. What you can assume, if they say it's 4%, typically your bank takes 2%, so it means your mortgage is 6%. And that's why listening to what the RBA has to say is important, because they've effectively increased the interest rate to slow the economy down and drop it to stimulate the economy. And some people are thinking that in the next year, Kate, that interest rates from the RBA could drop 1%. So if you're paying 6% on your mortgage, it could go down to 5%. Now, that's expectations. It's not necessarily reality. But we do have an update for people, which is that in the United States over the past month, interest rates were cut, and they were cut pretty significantly. They were cut by 0.5% in one go.
So that's a big jump.
That's a big jump. Normally when they make decisions on interest rates, they do make 0.25% or 25 basis points. That's typically the rate at which they increase or decrease. However, I say that normally the first cut down, so the first decision they make to go down, is a bigger one. And the reason that they do that is because they want everyone in the economy to think, oh, they're serious. They want to stimulate the economy. And obviously, if you're a mortgage holder, like you and I are, you wouldn't know if your mortgage is 0.25% higher necessarily or lower. So what they try and say is 0.5, let's cut it in a big way. So everyone is then paying attention. Everyone goes and checks their mortgages, goes and checks their term deposits and make sure that they're acting on that information. Does that make sense?
Yeah. So if you're on a variable home loan, you'll get an instant hit from that news.
Yeah, you should. Now, the banks are typically, good old banks, they're typically slower to reduce the interest rates than they are to increase the interest rates. So maybe a year or two ago when they were increasing interest rates, you would have seen the banks, quick as you can snap your fingers, they increase their mortgage rates, so you're instantly paying more. But when on the way down, they might wait a few days. They might slow it down. They might pass on a little bit. But fortunately now, thanks to some government intervention over the past 10 years, we're at a point where it's pretty competitive here in Australia. Even though we've got 4 big banks, Macquarie, Bendigo Bank, Bank of Queensland, even though we've got some big banks, those other banks are now applying more pressure. One of the banks that we reference pretty often is ING, and a Dutch bank that operates here in Australia. That's an example of international competition as well. So all that means that mortgage holders are able to switch easier. They're getting better rates. The banks are more transparent in passing along interest rate savings. All that said, we probably won't see an interest rate decline just yet, but hopefully it's on the horizon here in Australia.
All right. Now, today, before we get into all of the data of what's been happening in the market over the past month, I thought it'd be really good to talk about the S&P 500 index, because we hear about it when we watch the news, when we read an ABC article about how the markets are doing, and they just refer to the the S&P 500 or the S&P 500 index, but there's not often that much clarification on what is this index, what companies are inside of it, where is it, and also how do you invest in it? So I thought we'd touch on that for a little bit today to just give you an explainer of how do you invest in the S&P 500 index from Australia using an Australian brokerage account.
Sure, yeah. So what do you think's more popular, hearing the word Dow Jones or S&P 500?
I don't watch much financial TV, but Dow Jones seems quite, I don't say that word much, whereas I say S&P 500 a lot. So I don't know, but that's just my little finance bubble.
Yeah, maybe I think that in the general population, I think the word or the phrase Dow Jones, the name Dow Jones, is more popular.
It makes me think of David Jones, actually.
Yeah, well, interesting, because it's, as we know, it's not that. But the S&P 500 is the most popular what we call index in the US. So if you're tracking the entire US stock market, the S&P 500 is the one you want to track because it includes companies from all over America of all different shapes and sizes. The Dow Jones is one of the ones that's been the longest running. I'm going off the very top of my head here. I think it was, I'm going to guess it's over 150 years old now, the Dow Jones. Now that one is different. Even though it's in the media a lot, that only includes 30 stocks. So Dow Jones, 30, and they're kind of hand selected. They're not necessarily just like naturally the biggest companies, whereas the S&P 500 is the 500 biggest. So in terms of like getting a more representative sample, anyone that's done statistics would know this or just appreciate the law of large numbers. 500 is more representative than 30. So the S&P 500 is 500 of the biggest companies in the US. The reason why we use that and not the NASDAQ 100, which is another popular thing, which we'll reference today. So the NASDAQ 100 is just 100 companies from the NASDAQ stock market. And it at times also excludes things. So, and it's also artificial in the way it's constructed. So basically the S&P 500 is the best and purest way to get a gauge on what's happening in the United States stock market overall.
Yeah. And so if we want to be invested in the growth of the US economy and global companies, because as we've spoken about before on the podcast, a company like Apple might be listed on a US stock exchange, but it's selling its products in most countries around the world. We all have, I mean, we've probably got about 40 Apple products in the office right now. So it's a really interesting one to be invested in.
Yes, it is. And one of the things that's really interesting to note is like if you invest your money from Australia into the S&P 500, that's obviously going to like US dollars and it's going to US companies. But then those companies, as you say, earn money from other countries like Australia. So Apple might sell products in Australia. It might pay its suppliers in China and might send that money back to the US, which then you own from Australia as a shareholder. So it's a perfect illustration of the world being globalized and the ability not just for investors to go overseas with their money, but also for companies to operate around the world. Like you go back 50 years, it was so much harder for that type of thing to happen. But now obviously we've got internet, we've got relatively stable geopolitics, like even the countries that disagree, like China, America, Russia, these types, they still trade with each other. Europe, they still trade. So we still see that connectedness. One of the things to keep in mind is that when we did some numbers on this and when we researched some companies, we found that about 30%, depending on the year, about 30 to 35% of the sales of the biggest companies in the US come from outside the United States. So even though you're investing in a US like stock, being one of those 500 stocks in the S&P 500, the companies themselves are internally diversified. Apple's a good example, Microsoft, Tesla, basically anything around you right now is a good example. You can even invest in companies on the United States Stock Exchange that aren't American companies. So they just happen to have, that's where their shares are traded. And so there's this like, I think there's this like myth in investing that you as an individual investor need to be globally diversified and you need to own like an ETF or whatever from all around the world. But you know that people walking around on the beach in Positano, Italy are going to be using an iPhone. So you don't need to go and invest in Positano, Italy in order to have some sort of like financial exposure there. You can invest in Apple. And And vice versa, people on the beach in Italy can invest in Apple for Australian exposure. And so I think people need to move past the idea that they need to own an everything ETF and just be really mindful about what it is that you're actually getting. And so we actually invest in the iShares S&P 500 ETF. The ticker symbol is IVV. And this is the lowest cost ETF that you can use here in Australia to invest in the top 500.
And I'm looking at the IVV ETF website right now, and I can see that the biggest company that's held in that ETF is Apple. And then the second biggest, I've got Microsoft, I've got Nvidia, I've got Amazon, Meta, Facebook, Alphabet, Berkshire Hathaway, Broadcom, Alphabet, and Eli Lilly. That's probably the only one I haven't heard about.
Yeah, there's some great companies in there. And if you keep going further and further down, you'll find many names. The difference is that if you invest in one of, say, like the 50th biggest company in the United States, it's probably as big as our biggest company. That's the reality. Now, those companies which you just mentioned are in the trillions of dollars. I know like Berkshire just cracked that, I believe. So, these are gigantic companies. They're in US dollar terms as well. Convert that to Aussie dollars, they're even more gigantic. And they're truly global businesses. And I think that when you look at the types of companies that you get in the United States, like you mentioned those names, if you were to look at the top 10 as you just did, you would see that the common theme is technology. If you looked at the top 10 in Australia, you would see that the common theme is banking. We've got BHP, Rio Tinto, and Fortescue, which are three massive mining companies. But the predominant amount of our money when we invest in Australia is going into the banking sector. Again, that's not such a bad thing, because even though you're investing in banks, what do banks do? They take your money and they lend it to other businesses and to individuals. So in effect, they're internally diversified as well. Warren Buffett had this famous quote, it's not repeated as much these days, which is that in effect, a bank is a bet on profitability, because a bank has to be profitable. Otherwise, the society won't run. So that's why he owned so many banks. He owned Wells Fargo before it kind of blew up with this cultural thing, but many businesses like that. And so, yeah, you get diversification here in Australia, but not true diversification like you have in the United States. Like out at CommBank, for example, I actually saw I was on my way to Canggu and Bali. Okay, random story. And I saw a Commonwealth Bank branch.
Really?
Yeah, it's a brand new one. It was amazing. Right, really nice. But that is the only time I have seen an Australian bank outside of our shores. So
some have tried, some have failed.
Yeah, but you don't invest in our biggest companies for that global diversification. From that perspective, you might do BHP. Maybe you could say it sells in China, but that's the kind of core difference.
Yeah.
Those US companies are truly diversified because technology goes anywhere. And we own it, and we like the ETF.
So if I buy units of the IVV ETF, I'm just getting a basket of the 500 biggest companies in the US in one transaction. It's that easy?
Yes, that's the key thing. So 15 years ago, maybe CommSec was offering you international trading, but 15 years ago, you would have to open a special like sub brokerage account, or you'd have to open a Charles Schwab account, which is like one of the big US brokers, or an Interactive Brokers account for some people that are familiar with that. And those are basically the early stage of platforms that allowed you to own US shares. And just like the Australian market at the time, you would go one by one and just buy the stocks that you wanted to buy. But thanks to the beauty of technology and where we are globally now, you can put your money through the ASX, the Australian stock market, and it goes to BlackRock, which issues this IVV ETF we're talking about. And then that effectively invests in the US for you. In one purchase, your money is exposed to 500 companies, which makes it a lot easier. The same could be said if you wanted the NASDAQ 100 from BetaShares, which is a sponsor of our podcast. You get the top 100 on the NASDAQ, And so the reality is you don't need to do any of that stuff now. You can just get one investment that it gets you exposure to hundreds of different companies. And I think this ETF or ETFs that invest in the S&P 500, generally speaking, is the right amount of diversification for Aussie investors.
What are the risks that we need to think about when investing in the S&P 500 through an ETF like IVV?
So just speaking generally, because you've said like S&P 500, there are different ETFs you can choose from. Just because we use the S&P 500 ETF from iShares, which is IVV. It doesn't mean you can't invest in one of the other ones. They're all fine too. This is just the one that we prefer. But like, if we talk about the S&P 500 from Australia, you're converting Australian dollars to US dollars. So that's obviously a currency conversion. And anyone that's gone overseas on holiday will know that that can impact your purchasing power. So whether or not you have more or less dollars in the future. For example, if you go on a holiday in Europe, you have to be mindful that if you transfer all of your money in one go to that currency like euros, it might change, it might fluctuate. So you need to rebudget. And it's the same thing as if you invest in the United States and something happens to our currency, that's something you got to be mindful of. Obviously, the big one for most people is that the US economy is extremely strong. It is the strongest in the world. There is no doubt about that. And the political system, while it has its shortcomings, obviously everyone has an opinion on that, it is probably the most powerful democracy in the world. It's probably undoubtedly the most powerful democracy in the world. And that has so many strengths to it. Now, the obvious question mark is, well, what happens if it's no longer the biggest spender on defense, the biggest spender in terms of like societal pressure around the world to keep, other countries in line? What happens if there's a falter in the US like system at large? That's the key fear amongst most investors that invest in the United States is you invest in the top 500 companies, geopolitical reasons and events occur that then mean that your money is invested in companies that are now something is happening. But if you think about that, like the same could be said about any country, and including our own. So we could have issues that happen here domestically. And if you have all of your money exposed just here, like let's say you just have, a property and some shares, you're all in on Australia. But Australia might be the one that's unlucky. Like we've been the lucky country for 150 years, so to speak. So realistically, having diversification should actually lower your risk in that regard. So we've got currency, we've got the just general political situation or geopolitics, as we like to call it. And then obviously there's just performance. The US share market is the second best performing stock market in the world over the past 123 years. The best is Australia.
Really?
Yeah. So the third from last year's tables was South Africa, but it could be wrong. It might have been one of the emerging markets. But, we've been very blessed to be number one. Number two is the US. So those two things might not always be true. So that's just a general investing risk.
Okay. So I think that gives us a really good overview of IBBs and in just investing in the S&P 500 index in general. Is there anything else we needed to cover there?
I would just say that the S&P 500 is wonderful. You can go about it. You can actually neutralize at least some of the currency risk by having some of your money in a currency hedged version. So this is where the impact of currency is taken out of it through, let's call it financial engineering. Realistically, you just peg at whatever currency level you're at, that's what you get. And those ETFs tend to cost a little bit more than the unhedged version. We have a little bit hedged in that. The other thing that is the big thing is make sure you're diversified. As good as the US stock market is, like we have some people in our community say, I've only got US stocks, which to me is pretty risky. A little bit of everything is probably the nicer way to do it. Sure, the US economy is very strong, but it could be a little thing that gets in your way. Like it could be a currency movement. It could be that the broker that you're using, something happens. It could be that you forget to fill in a W-8 BEN form, which is a tax form, and little things get in the way. And those are annoying things. So make sure you're diversified, minimize the risk of those things happening, and just keep diversified, keep on top of your portfolio. And that's really it.
So next time you hear about the S&P 500 on the news and hear what it's done that day, that month, that year, it's just the top 500 US companies.
And it's easy to invest in. Yep, absolutely. And that's that.
That's that. All right. So what everyone's been waiting for, our market update for the last month. What has been happening, Owen?
Let's put a timestamp on this, the 24th of September.
Ah, yes, in the morning. 12:18 before the announcement. So.
Yeah, so we do like to record a couple of days in advance, give our team some editing time. And the reality is we don't know what's going to happen with the Reserve Bank of Australia's update today. I thought it was next week. So that's okay, because it looks like it's going to be held flat. But basically what's happened over the past month, Kate, is the thing that we led with at the top of the show is that the US economy and everyone in it now get lower interest rates. And as it is the strongest economy in the world, basically what that means is typically the United States economy leads the rest of the world, even places like China. They might move in different ups and downs, but China would take its cues from what's happening in the US because it's a big export partner and so on and so forth. Same with Europe. And Jerome Powell, the chair of the Federal Reserve, which is the equivalent of the RBA, they come out and said, well, we think we've got inflation back under control. The economy needs some stimulation. We're going to cut interest rates by 0.5%. And it's been actually really interesting to watch the changes then flow through to different ETFs or different stock markets or different types of markets and the implications that that's had. I wrote about it in our email on the weekend. If you haven't already signed up to our email, you can get that by just creating a free account or joining our community. But the basic implication of falling interest rates, Kate, is that overall, everything else goes up. So if you own things, like say you own shares, Aussie shares, US shares, property, everything else goes up with the exception of interest rates, which apply to mortgages. And the other one is term deposits. So every month when we do this market update, we come on here and we report the same bank's 1-year term deposit. It's not because we like ING's term deposit necessarily. It's just because it keeps it consistent. So you can see what impact this has. If I'm not mistaken, over the past 2 months, ING's 1-year term deposit, so this is if you locked your money away for 12 months, it went from 5.1 to 5, and now I believe it's at 4.95. I could be mistaken though, Kate, so feel free to fact check me on that one.
Yeah.
We'll bring this up now. So one thing we do every month, Kate, is we look at the term deposits of one bank, which is ING. It's not because we love them. It's just because we use the single bank so you can get a sense of what impact interest rates have on your day-to-day life. The ING term deposit was, for 1 year, if you locked your money away, above 5%. And every month it's been slowly and steadily falling. It's at 4.95% now. But interestingly, Kate, you just raised another point about the 2-year term deposit.
Yeah. So they're offering 4.4% for 2 years. So if you lock in for 2 years, you're getting a lower interest rate than if you locked in for 1 year at the moment. And that indicates that ING think that interest rates are going to fall a bit more.
Yeah. So in this instance, we've got 4.95 for 1 year, 4.4 for 2 years. This is obviously per annum. And basically what that's saying, as you said, is that retirees and people that tend to hold cash will get less of a return over time. And people that have held cash for the last couple of years have been like, yes, I've got a really good interest rate. But reality is inflation's been high. So the price of your favorite mainland dairy, cheese, I'm looking at you, vintage variety, I can see the price of you has gone up, right? And it's gone up most of the time faster than the interest that you've received. So even if you were one of these people that are like, yes, I got a really good term deposit rate or really good savings rate, the reality is that you were probably being beaten by inflation. And now you can see that your rate is dropping. So we've always got this question of, should I, hold cash or should I invest? Almost always over the long term, it's better to invest for this very reason. You can still get a good interest rate on a savings account. You'll get a better interest rate on savings account. And so what you can see is that if you have a savings account, which is variable month to month, that's high. 1 year is okay. 2 years is really low. And then 3 years and 4 years and go on and on with different banks, you'll find a trend. And basically what that's saying is we think interest rates are going to fall. So we're not going to let our customers lock in for higher rates. And for mortgage holders, basically what that means is it's good news. If you're on a variable rate, like many of us are, as we've kind of cycled off our fixed rates from COVID, now you're going to start to see that rate come down. The key thing is it can start to come down before there are official cuts to interest rates. And the reason it can come down, Kate, is because, say, for example, ING, global bank, it might get some of the funding it needs from the United States. And because they've cut their interest rates, there's a chance that your mortgage rate, if you were with ING or whoever, could actually come down.
And they don't need as much in their savings.
Exactly.
Yeah, because I can see they're 5.5% at the moment for the ING savings account, but because it's variable, as you said, they can change that at any time.
Yeah, at any time. And so this is falling interest rates are typically bad news for retirees that need income from cash. So if you're a retiree listening to this, like if you've invested with us, for example, through Rask Invest, you would know that when we set it up, and I deliberately talked about this when we launched, we had 2 ETFs in our portfolio, the IAF ETF and the VBND ETF, which are also in our notes for this month. Those 2 ETFs have started to perform really well. And the reason is that they're government bond ETFs. So they actually benefit as interest rates start to go flat or fall. And that's what we're starting to see. So retirees that just had cash and relying on, the good old fashioned bank account will now start to get hurt if interest rates start to fall. So thinking about bond ETFs is really important. And it's also why many of our younger people, like myself included, had bond ETFs. People were like, well, why would I own a bond ETF if I'm investing for the long term? Well, 1, it provides protection. But 2, it can actually go up when stock markets get a bit of the jitters. 3, it can go up when interest rates start to fall. So it can deflect some of this pain and you still get income. So why not? And so we're starting to see that diversification benefit play out. Interestingly, over the month, we haven't seen the Australian bond ETF is flat, but the US bond ETF that we invest in is predominantly US, VBND, is up 0.66%, which is a lot for 1 month.
And does that reflect their interest rate cut?
Yeah, because off the top of my head, about 70-ish% of that ETF has US bonds in it. And then the rest is from the rest of the world. And so effectively what you're getting is a lot of those, bonds that are coming from the United States government. So as those interest rates have come down, the ETF itself has gone up. And that explains the difference there. As we look across to the Hang Seng Index, which is an index for stocks in Asia, that's up 4.7% for the month. Now, this is obviously an index which some months when we come on here and talk about it, it's down really bad and then it's up and then it's down. And it's typical for a more risky type of region. But interestingly, that's up a long way. Now, there could be many reasons for this in particular, okay? But one of the reasons we might infer from this is that a lot of those countries in Asia and emerging markets, we call them, actually need to get their funding in US dollar terms. So you might hear of like Asian currency crisis, different debt crisis and stuff. That's because a lot of those emerging economies rely on investors from developed countries. And when they trade their debt around and when companies go and find money to invest in their country, they have to switch their currency to United States dollars because that's what the investors are lending in. So that's why when interest rates fall in the United States, it can actually be really positive for them. If we keep going down, we see that the NDQ ETF from iShares is flat month over month. The IVV ETF is up 0.65, so about 1% difference between those two. Here in Australia, the VAS ETF is up 2%. Various reasons for that. It's not really much for us to go on, but it could be that the United States cutting interest rates is now being reflected here in Australia. And we did see that. The expectations for Australian interest rate cuts has kind of been brought forward and a bit more significant. So for anyone listening or watching this, you can go to something called the RBA Rate Tracker, and it will show you what investors expect to happen in the future. This can be wrong, and it's quite often wrong, but what it shows you is effectively where professional investors think interest rates are heading. And that's why we know we're recording on an RBA day, but effectively, people don't expect interest rates to be cut today. They do in the future, but not today.
Yeah. It's fascinating to see how one decision in the US, which although it's a huge part of the world, it's one country, has such an impact on global stock markets and bond markets and what we're getting on our savings account and what we're paying for our mortgage.
Do you remember what, in fact, that people might not be familiar with on the show is in the US, you can lock into 30-year mortgage rates.
Really?
Yeah. So you can lock in your mortgage for 30 years. So if you're like a young couple that bought a house in the last 3 years, you could have locked in like 2% interest for the rest of your life, basically.
But how's that good for the lender?
It's because what they can do, so they can get, so say you come in.
They lock in.
Yeah. You can say, oh, okay, I'm the bank, you're Kate that's just bought a house. You want a 30-year mortgage? You're like, yeah, I'll get certainty over my budget. Sure. Okay, I give it to you for 2%, but then, I get the funding from some professional pension fund investor back here for 1.5.
Right.
So all I've done is match what you're giving me with what I'm paying to them, and I earn a little spread. And that's how they do it. Whereas here in Australia, we don't really have that source of funding. Predominantly when banks lend money to you for your mortgage, they're getting it from term deposit holders. And so that's why when you get a 5-year term deposit, that's not that common. And that's why you don't get 5%, 5-year fixed rates as well. Does that make sense?
Yeah.
So the source of funding kind of determines what is offered to the consumer at the end of the day. But anyway, that's interesting. The other thing that's quite interesting from this month is that we also see gold jumping. You might remember, if we think about like decisions that get made, remember at the beginning of August, this is not that long ago, it's like 7 weeks ago, long time in the investor's mind, but 7 weeks ago, remember there was like the stock market fell like 4% in one day, and like people were talking about the Japanese economy, and you might have heard something like a carry trade.
Not really, but I'm very not checking investment media at the moment.
So if you go back to the beginning of August, you might have heard or seen in your brokerage account that like ETFs like the NDQ ETF, NVIDIA fell 15% in one day. Like this was like a temporary...
Oh, I heard about NVIDIA. Yeah, I remember you mentioned it last month.
Yeah. So the reason that happened was because the Bank of Japan increased their interest rates. But this was like the first interest rate increases in however long, like so long. And basically everyone that was getting money from Japan would take the money from Japan and invest it in the US. But then when the source of their money, which was Japan, was going up, they all of a sudden realized, hold on a second, this can't do this anymore because it's more expensive. We can't keep doing this. So they had to quickly put their money back. And that's what caused yeah. So anyway, that's how it's all connected. And I'm sorry if I'm getting passionate about this, but that's the reality. Bitcoin, month over month, down 1.7%, but still up over 40% for the year. Finally, this is probably the thing that's really interesting for anyone traveling at the moment. The Australian dollar is at 68.5 US cents. This is up from 64.88 in early August. Flat year to date, but up 7% over the past year. The reason why this is important, other than for people that are traveling, Kate, if you invest in that IVV ETF, you've got to be aware that if the currency moves, the actual stock market might go up. But because the currency is going down in US dollar terms, you might not get the return that you think. So in our portfolios at Rask Invest, we have a very small amount of currency hedged ETF, the IHVB ETF.
So you use 2 ETFs to invest in the S&P 500.
And we've got a lot of questions about this. So for anyone that's listening that invests with us, you'll understand why once you hear this. When we started the service, late March, early April this year, the currency was really low. And I saw that and I was like, well, even though you probably don't really need a currency hedged ETF, like the reality is you probably don't, for Australians anyway, we still needed some because it was so low that we could potentially benefit when our currency, like it is now, comes back towards a more normal level, which is like 70 cents or 70 to 75. So in terms of that playing out, that's playing out so far. However, I did bet my father-in-law, because he was traveling with mother-in-law in Rome at the same time we were. I said, if it gets to 70 cents, you can buy me a pizza. It definitely did not get to 70 cents. It's currently 68.5. So Mick, if you're listening, it's still on. We're still in this race. But the reason that the
pizza might just have to be in Melbourne.
Yeah, it might have to be a Melbourne pizza. I'll take a Doc pizza, to be honest with you. Anyway, DOC, Doc Pizza in Melbourne. One. Yeah, she's giving me the nod. Okay, so anyway, the reason that the Australian dollar is going up, Kate, is because currently in Australia, we have pretty high interest rates. Meanwhile, in the United States, everyone's thinking the interest rates are going to keep falling. So what does money do? The money floods into Australia. which then drives up our currency because people want Australian dollars.
They want to put money in our term deposits.
Yeah, not the US. So you're seeing this big flood of money come back to Australia to be like, well, we need to get back into Australia because they've got good interest rates. Meanwhile, they're leaving the US. But if we were to start cutting our interest rates, you would see that momentum will shift again. And that's, again, how we're all interconnected. And so in terms of what you should actually do about that, pretty much nothing, to be honest. A lot of people are asking us, like, should you use a currency hedged ETF? That boat has probably sailed a little bit. I think you should maybe consider having a little bit in currency hedged exposures, but you don't want too much. I'm not sure if that helps, but I wouldn't put too much in it. Yeah.
Well, we've covered a lot of numbers there. And as you can see, one of us is looking at the numbers all the time and one of us is not looking at the numbers so much, but we're both invested in ETFs and neither of us touched our portfolios this month.
We didn't make any change, but that's because of the work that we did was last year in anticipation for this. So, not everything's perfect, but that's why you have a diversified portfolio. That's why you use ETFs as the core building blocks. And while you might tinker with some of them, you don't really have to make a lot of change all the time. We were just talking about before, someone in our community did say that they've sold out of their portfolio. And my comment was, listen, I'm not going to judge you for doing that if you're scared or whatever. But here are the reasons why you probably don't. Like, you might want to consider the alternative is that it's still a pretty good time to invest. And that's the whole purpose of this podcast episode we do every month, is to try and reassure people of what matters and what doesn't. And so far, we've seen a big change from the US central bank. We could see a similar change from the Australian central bank in the next 6 to 12 months, but it actually is good for investors. There's a difference between the economy struggling and the stock market reacting. Typically, as interest rates fall, it means the economy is struggling, but that typically means good news for investors because we have things that benefit from it.
So takeaway, stay invested, stay investing.
Stay investing. Yeah, for anyone younger, stay invested. And for anyone older, it's time to start thinking, what do you do with your cash? I think that if you don't have a balanced portfolio with some bonds, there's still time to put money into those types of ETFs and to build a truly diversified portfolio that will still pay you income even as cash rates fall. It's not, I don't want to sound alarmist because it's not at all that. It's not bad news. It's just you got to adapt to what's going to come in the next 3 to 5 years. And I think that personally, I don't think the 5% interest rates are sustainable with so many people in debt. I think what's more sustainable is a 3 in front of that number and inflation under control over the next 2 or 3 years.
Wonderful. Well, I think that just about wraps up everything we wanted to cover today.
We covered a lot, Kate, and sorry if I did get into the weeds, but I did do an update via email. So the best way to stay in touch with these types of things is via email because you can see all the numbers written in front of you.
Yeah, we'll put the too long didn't read or didn't listen option in the show notes for you so you can have a look at everything we talked about today.
Wonderful. Kate, welcome to the new office. This was great fun, so thanks for joining me.
Thanks for listening, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.